Boom, we are back. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding, back again at the computer screen. Hope everyone's having a great day. If this is the first time that you're tuning in with you, make sure you hit that subscribe button, thumbs this video up. We are bringing you a ton of content, both through written form on focuscompounding.com, audio form between Geoff and myself with the podcast, and now I'm also going to be uploading video content as well, really just going through the process. So if anyone recommends anything, feel free to leave a comment down below, and I will do my best to make a video about it and see if I can help you out. The best place to get everything that we put out on the internet is probably Twitter. This is where pretty much all the content comes out first. So make sure you follow me on Twitter at Focus Compound. Look at that. Somebody made that. That's funny. At Focus Compound on Twitter. And that's usually the best place to get all the information that I put out on the internet. So in today's video, the other day, I released our checklist for starting a new company. And in today's video, I'm just going to be going through one of the first parts of the list. Find 5 peers. I'm not going to go through that. You could do that just by Googling around. I think Guru Focus also has a peer group, and there's just other sources on the internet. And I think my time would be better spent going through number 2 on the checklist. I plan to go through every single one of these and make a playlist out of this. So again, like I said, make sure you hit the subscribe button to get notifications whenever I upload a video. So number 2 says, get the longest term stock chart possible, record the number of years, and use MoneyChimp CAGR calculator to get the long-term return. We're doing this because we want to make sure that the stock works geometrically over time. Now, people may be surprised that we do this, but I will go in and show you why Geoff and I do this. Basically, we just want to make sure that the stock has been able to perform over time. Of course, if you are taking a stock chart, you're not accounting for dividends, but if you think markets over time do maybe 8 to 9%, and if Geoff and I are managing other people's money and we're throwing a fee on top of that, well, we definitely just want to make sure that we're going to be just fishing in an area where a stock has historically performed well. I know stories change all the time at companies, so the past may not be the best indicator for the future, but the way that Geoff and I invest, because we look and focus so much on predictable companies, we have just found that this is just a quick, easy measure for us to do in the beginning. So the company I'm going to be going over for this series is VeriSign. It's not an overlooked stock, but I do think it's a good stock and one that I have followed for a very long time. The financials I will be using in Excel, I just got it from just download financials. So I haven't normalized anything. I haven't adjusted anything. I'm just going to really use whatever was pre-populated just for demonstration purposes. So VeriSign is, they're pretty much running a legalized monopoly, which is an interesting business to study. They generate a lot of free cash flow, and they use all that free cash flow basically to buy back their stock. They are the sole domain registry for .com and .net. So it's a very interesting business to study. I actually have not looked at it in a very long time, but I've always just followed it because I've thought it's a pretty good business. And when I say not look at it, I mean like haven't really read the filings or anything. But so you could go to otcmarkets.com and type in whatever ticker, and we could literally just do the 1 year and kind of go from there. We use the CAGR calculator, which I put in the show notes last time. I'll also put it in the show notes this time. If you know how to do an IRR calculation through Excel or a calculator, it's just the same thing. I'm really just using this because I always use it, and I think it'll just be good for demonstrating the stock. So you could go to the 1 year. We'll take the 1 year, maybe the 2 year, the 5 year, the 10 year. This company was involved back in like the .com craze, so I'm not probably going to take the stock chart from back then. As you can see, it looks like in 1999 and 2000s, it was up at like $243 a share, but we'll just kind of figure out what we're going to do. But the 1 year, this is very simple. I hope this is, it's not meant to be complicated, but we'll just take, and of course it doesn't need to be exact, $189, right? And then the stock is currently trading at 205.46, 205. And again, this does not include dividends. So if the company does pay a dividend, make sure you take that into account. And the 1 year return is, I should format this to be percents, is 8.7%. Really wouldn't put too much weight into 1 year returns, of course, but we're just going to keep up and go from there. 2 year returns, let's look like $124.95. $124.95, and that's still trading at 205.46. We can calculate that. Now that's a 28.23 return. And that's, again, not accounting for dividends. I don't know if they actually pay a dividend. Like I said, I know they do buy back a lot of their stock, but it's just something that I like to track. Let's see, $65.08, and that's a 5-year return. $65.08. We could change that to 5. 25.85. And then we could go back, let's see, 10 years. So if we go back 10 years, we'll just pick a spot in the beginning of 2010. It looks like $22.55. And then change that to 10. And it looks like it's compounded over 10 years, not accounting for dividends, if they do pay a dividend, at 25% per year. So we'll enter that in, 24.73, 25% per year. So this is something that we do in the beginning because we just want to make sure that the stock works geometrically over time. As I said in the past video, if a stock has a 1 in 10 chance of blowing up, that means it's going to blow up 1 every 10 years. So the way that Geoff and I invest, we want to stick to incredibly predictable companies. We're very concentrated investors. That's the way that we run the capital for our firm. So we want to just stick to these very durable, good, high quality businesses. And this is just something good that I love to do every single time, just to make sure that you're almost going with the waves, if you will. And I could show you what like a company like GE will look like and do the same experiment or whatever. And again, there's nothing so magical about this. This is just putting, I think, the odds in my favor that the stock is assuming that it keeps on doing business as usual while you're in a good situation to make money. And of course, like I said, this takes nothing to do with the fundamentals, but Geoff and I just like to do this every single time. Let's go and look at a company that's probably done absolutely nothing over the past 20 years called General Electric. So let's go back. We'll do the 1 year. It looks like 9/31 about a year ago, and we are currently trading $6.50. Good job. The only people that buy this stock are financial advisors for their clients. Okay. Nice. -30%. So we'll enter that in. Okay, we could do the 2 year. So it looks like it was trading at $14.61. Again, this is just a rough estimate, guys. $14.61. Get that right? Yep. And that is 2 years. That's a -33%. We could do the 5 year. I'm not necessarily worried about the 1 year or the 2 year, but the 5 year and the 10 year is definitely something that you should take note of. 5 year looks like it was trading $26.87. And that's 5. So that's -24% per year. Then we could go and do 10 years just for fun. And I didn't really pick this company on purpose. I just think it's, good for people to see. The opposite of VeriSign looks like. So it looks like $16.21 $16.21 over 10 years, and that's -8.73% per year. That does not sound like a good return, especially when accounting if you think markets do 8% over time, and that was in one of the greatest bull markets in history. Now, if you manage capital yourself, and let's say you have a 1% fee, well, you tack on a 1% fee, and you could use this almost like a hurdle rate as well. But I like to do this in every single company that we look at, like I said, really just to make sure that you're going with the flow. It takes really nothing into account when it comes to fundamentals, but this is just something that Geoff and I always like to take a look at. So I'm going to be making a video going over everything from the list and start to get into more complicated things, but I'm happy to do it. So I want to thank everybody so much for tuning with me in this short, quick, and hopefully easy video. Make sure you hit that subscribe button, thumbs this video up. Excited to bring you guys a lot of content, and I will see you in the next video.